Welcome back to the Deep Dive. Today we're looking at the standalone financial statements for Pine Labs Limited for the year ending March 31st, 2025.
Right.
And the big story here, signed off by the auditors BSR & Co. LLP, is a financial year defined by just an absolutely massive turnaround.
It really is. And this is a major Indian fintech company, so they're reporting under the Companies Act and Indian accounting standards. On the surface, the auditor gave a standard, true, and fair view opinion.
The clean bill of health.
Exactly. But when a company reverses billions in losses in a single year, the headline profit is, well, it's only half the story.
Right.
Our job is to go into the footnotes, the annex reports, and really look at the control deficiencies the auditors found.
Okay, so our mission for this deep dive is twofold. First, we need to dissect how this financial shift even happened.
Yeah.
Where did the losses go? What drove the profit?
And
Second, and this is crucial, we have to look at the risks they flagged. We're talking about major internal control gaps and billions in disputed tax liabilities.
let's start with the hard numbers then, because the shift is, it's genuinely extraordinary. We'll be talking in millions of Indian rupees, by the way.
Okay.
So looking at the profit and loss statement, total income, it showed solid growth. It went from about 13,747 million in fiscal 24 up to 16,951 million in 25.
So solid growth on the top line, sure. But the bottom line is where Pine Labs, well, it looks like they performed a financial miracle.
A miracle driven by expense management, maybe? The key metric is profit before tax, PBT. In 2024, the company posted a devastating loss of 2,401 million.
Wow.
But by 2025, they had completely flipped that. They posted a PBT profit of 584 million.
That swing, that's over 2.9 billion rupees. It's colossal. It takes the final net result from a huge loss of 1,871 million to a profit of 435 million.
Right, and that obviously flows down to the shareholders. Earnings per share moved from a loss of 2.23 rupees to a profit of 0.52.
So when you see a reversal that big, the question isn't if they made money. It's how on earth did they erase those expenses so fast?
Precisely. That kind of change, it rarely comes from just core operating sales. We saw revenue increase, yes, by about 2.6 billion, but the loss reversal needed a lot more help.
Okay.
The answer is in two major, and I'd say highly variable, expense reductions.
All right, so let's unpack the first one. The most dramatic one, the impairment charges.
The biggest change, by far, came under impairment of non-current assets. In fiscal 24, they booked a heavy impairment charge of 617 million.
And in 25?
It plummeted, just 83 million. That reduction alone, that accounts for over 500 million in savings, directly boosting the profit.
And the source material explains this, right? It was a non-repeatable event. The impairment last year was on things like their POS devices and other intangible assets.
It was. Management was evaluating technology obsolescence.
So it's like a massive spring cleaning.
That's a great way to put it. You have a fleet of technical equipment, you realize it's outdated, you have to take that full financial hit, that write-down, in the year you realize it. That was FY 2024.
So once that value is cleared off the books, the expense just doesn't repeat.
Exactly. It's a deliberate financial strategy. It dramatically helps the bottom line in the next period, but it doesn't mean your core operations are suddenly that much more profitable.
And on top of that big impairment reduction, they also saw a drop in their routine asset charges.
Yes, depreciation and amortization. That expense fell pretty significantly, too, from about 2,659 million down to 2,017 million.
So you combine those two asset-related savings, and you've basically wiped out the prior year's loss.
Pretty much. But the income side also got a huge, and maybe you could say artificial, injection. Let's look at the surge in other income.
Okay.
Other income nearly doubled. It jumped from 416 million to 978 million. And if you go into the footnotes, the main driver was a massive increase in service charges from related parties.
How massive are we talking?
It skyrocketed from just 29 million to 634 million in 1 year.
Wow. A 600 million rupee increase in income that came from inside the house, essentially, from related party charges. Is there any note explaining why that happened?
The notes confirm the movement, but they don't really detail the operational reason for this sudden surge. And that's a critical point for any analyst.
Sure.
It's legally fine. But a shift that big in intercompany charges suggests a major internal restructuring. It means the standalone entity's profit is highly dependent on, well, financial engineering, not just a surge in third-party merchant revenue.
So to summarize the profit story, it's a phenomenal turnaround, yes, but It's driven mostly by not repeating last year's big write-downs and a huge boost from internal transactions.
That's the story on paper.
Right. So now let's pivot to the controls that produce these numbers. It's one thing to celebrate the turnaround, but what did the auditors find when they looked under the hood?
This is where the story gets really fascinating. You have these great reported results, but the annexed reports from the audit reveal some serious, foundational weaknesses.
And the first one is about IT and data integrity.
The most immediate concern, yes. Let's start with basic business continuity. The auditor explicitly noted that for one of their accounting software applications, the backup was not maintained on a daily basis.
Not daily for a fintech company.
Not daily. In a business handling sensitive, real-time transactions, that lack of a basic daily backup is it's a severe operational oversight.
That is fundamental.
Yeah.
But the findings on the audit trail are, frankly, unnerving,
Right.
especially for data integrity.
The audit trail, the edit log, that's the digital backbone. It records every change. It's for accountability, preventing tampering.
And they found gaps.
Critical gaps across several systems. For one accounting software handling revenue, the audit trail facility was not enabled. Not at the database level and not at the application level.
So it's like a security camera that's turned off.
That's a good analogy, and it wasn't an isolated case.
No.
No. Across two other accounting softwares, the audit trail also wasn't enabled for certain fields relating to revenue, the general ledger, critical processes. It suggests a pattern of incomplete controls.
And the worst part of this, the part that really stands out, is the auditor basically had to say they couldn't guarantee the records weren't manipulated.
Exactly. Because of these chronic deficiencies across 5 different software applications, the auditor stated they were, and I'm quoting here, unable to comment whether the audit trail feature was tampered with.
That is a huge red flag in an audit report.
It's highly unusual. It means that while the final numbers might be materially correct, the confidence in the system that generated them is severely compromised.
That really undermines the trust in the very data we're looking at right now. And this lack of control isn't just digital, right? It extends to their physical assets, their core business, the POS devices.
Another key operational finding, yes. The auditor noted that Pine Labs mostly relies on system tracking to monitor the operational status of the POS devices out with merchants.
Meaning they see if it's online.
Right. But what they do not have is a regular, scheduled program for physical verification of these devices.
So the machines that generate their revenue are tracked by a ping, but there's no routine check to see if the device is actually where the system says it is, or if it's even in one piece.
Precisely. For their other property and equipment, physical verification happens just once every 3 years. For a fintech company with assets spread all over the place, assets subject to theft and obsolescence, that's a major control weakness.
So how can management be truly confident in their asset valuation if the physical checks are that infrequent and the digital trails are, as we've just heard, compromised?
It creates this fascinating tension between the reported profit and the reliability of the controls. Now let's shift to the balance sheet, because we see the sheer scale of this company reflected in 2 very different kinds of massive liabilities.
Okay, let's start with the first one. The huge liability tied to prepaid cards.
Yes, there is a gargantuan line item that just suddenly appeared in FY 2025. Liabilities towards prepaid cards. It totals a colossal $47,717 million.
Wait, 47 billion rupees. That's almost 3 times their annual revenue. Where did that come from?
It wasn't new debt. It was an accounting reevaluation. These are funds collected from customers for prepaid cards, and they used to be classified under contract liabilities.
So a reclassification.
Right. Management decided, based on contracts and new regulations, that this money should be shown as a financial liability. It's essentially customer funds held in trust.
That reclassification alone says a lot about how fast the fintech space is moving. The need to clearly show customer funds are protected. But that sounds like terrifying exposure.
It would be, but the risk is clearly mitigated, and that is the crucial distinction.
How so?
Pine Labs holds an almost equal amount in earmarked, restricted bank balances just to cover these obligations. The notes say $49,398 million is held in earmarked cash.
So that money can't be touched for general operations.
Exactly. It's legally segregated to protect the cardholders. So it's a massive funds management challenge, but it's not really a solvency risk.
That's a critical difference. Covered liability versus, well, contested liability. Let's move to the second type of risk, which is contested and could mean a real cash outflow. the statutory dues.
The risk exposure here is staggering. It's nearly 4.9 billion INR in total, across multiple disputes at various forums like the Appellate Authority and the DG of GST Intelligence.
4.9 billion. That's money they might have to pay if things don't go their way. And with revenue under 17 billion, that's a significant threat to their future cash.
It's massive, and the timeframes are long. The single biggest item is GST for the period 2017 to 2024, amounting to 4,282 million. It's pending at the Appellate Authority.
That's 7 years of operations under dispute.
Right. Then there's another GST dispute for the 2019-20 period for 366 million, and a lingering service tax dispute from 2012 to 2016 for 275 million.
They haven't paid much of it.
They've paid small token amounts under protest, but the vast majority is still being fought. That regulatory overhang puts enormous pressure on future cash planning.
Speaking of cash, let's quickly look at their liquidity. Despite the profit, the cash flow statement shows some tightness for the year.
It does. When you look at cash and cash equivalents, the company actually saw a net decrease of 2,449 million INR for the year.
A decrease.
And when you look at the final cash balance, it's technically negative, a negative 43 million.
Why is it negative?
Because that number is netted off against their use of cash credit and bank overdraft facilities, which totaled over 6,172 million. So while they're profitable on paper, they're actively using short-term debt to manage working capital. That points to liquidity pressure.
And how did that affect their overall leverage?
The debt-to-equity ratio, it increased significantly. It climbed from 0.28 to 0.41. That's a jump of over 45%.
Wow.
And it's directly from the increase in total borrowings, which grew from about 4.7 billion to 7.3 billion, not including leases.
And there was one last interesting detail about related party loans, right? Internal loans that the auditor couldn't quite assess.
A classic audit scrutiny point. Pine Labs gave loans to subsidiaries and a fellow subsidiary. About 125 million INR was outstanding. The auditor highlighted the problem. The loan agreements had no formal stipulation for when the principal or interest had to be repaid.
So it's just money lent internally without a structured repayment plan.
Correct. And because there's no formal structure, the auditor was unable to comment on the regularity of repayment. That lack of formality, even internally, is a control witness. It makes it hard to assess if those assets are really recoverable.
Okay, let's bring this all together. We started with this headline victory, a nearly 3 billion rupee turnaround to profitability in a single year.
A victory driven largely by not repeating massive asset write-downs and a big internal income surge.
But that victory is tempered, maybe even overshadowed, by the systemic operational risks that the auditors detailed. We saw critical weaknesses in their IT controls, from failing to do daily backups to having compromised audit trails across multiple systems.
Right, leaving the auditor unable to even confirm the integrity of the data.
And then there's the sheer scale of the balance sheet. The massive, but thankfully covered, 47 billion rupee prepaid card liability sitting right next to the very contentious 4.9 billion rupee threat of future tax outflows.
It forces you to ask a hard question. When you're looking at the stability of a high-growth fintech company like this, how much weight do you put on a strong income statement versus the specific, severe risks that you find buried in the operational reports?
That really is the essential conflict for you, the listener, to think about. What does the complexity of managing huge customer funds like? Reclassifying that massive prepaid card liability? What does that tell us about the speed of regulatory change and the pressure on transparency in the modern fintech business model? That's a question that goes way beyond a single P&L statement.